FreightWaves Radio, a weekly dive into driver issues, the flow of money, and how the economy is impacting the trucking industry over the short and long term. From economic drivers impacting freight volumes, rates, and seasonal surges, to the rise of new trucking technology, our market experts cover all that and everything in between. And now your hosts, John Kingston and...
Adding to the gloom and doom, we're going to start by talking today with Kenny Vieth, who is the president of ACT Research. He became a partner of ACT in 2000. He was named president in 2010. He oversees commercial vehicle analysis and forecasting at ACT, and he is the principal heavy vehicle market analyst at the firm. He joins us today on FreightWaves Radio. And Kenny, we booked you on this show a few weeks ago to come on here on the weekend of June 22nd and 23rd. And then this past week, you provided us with about 10 press releases of maybe not that many, but I guess it was probably 4 or 5 about your findings about various parts of the industry, none of which were particularly strong. But I did want to quote from one that came out just Friday, in which you talk about the Class 8 vehicle market. This was in regards to the release of your Transportation Digest, which I guess is a product for your subscribers, your clients. And you said that the heavy-duty market is at a, quote, inflection point. That sounds like the old half-empty, half-full equation. So first of all, welcome to FreightWaves Radio. I got kind of deep into it right away without allowing you to talk. And what exactly is the inflection point?
Well, thanks, John, and good afternoon, everyone. So if you recall back, I don't know, maybe 15 or 20 years ago, Alan Greenspan had the classic quote, "The law of supply and demand has not been repealed," and of course, recognizing that as good as everyone is driving trucks these days, transportation is a commodity market, and the situation we're in right now is the most freight dense sectors of the economy, whether it's manufacturing, machinery, auto or housing, are all flat to down right now. So our expectation for freight growth once we factor for productivity in 2019 is pretty close to zero, and at the same time, if we look at the Class 8 market, we're near record production levels. We're at near record retail sales levels. So guys are still buying a lot of trucks. So if there's two numbers to take away today, net freight somewhere between 0 and 1 in 2019, and Class 8 tractor fleet capacity somewhere around 7% growth. And in a nutshell, that's the problem. Is we're getting a lot more trucks chasing not a lot of freight.
Yeah. So when you say 0 to 1, you mean 0 to 1% growth compared to 2018.
Yeah, compared to 2018, and in 2018, we saw freight growth or net freight growth, just over 4%, and Class 8 population growth really didn't start ramping up until the second half of the year. So we had that's one of the things that really drove the strong rate environment into the first half of 2018.
So you came out earlier in this sort of slew of releases that you came out with this week. You summed up the market for new vehicles like this. Quote, additional data for the Class 8 market shows still large but quickly shrinking backlogs, weak orders, strong build, bigger inventories, and good follow-through on sales. That's a big list. Some of it, I think, could be considered bullish. Some of it could be considered bearish. They're not all in agreement with each other. So kind of let's take them one by one. Let's talk about the backlog. By the middle of last year with crazy high order books, if you ordered something, a Class 8 vehicle, in the middle of 2018, or maybe toward the end, you weren't going to get it until 2020. Where do those backlogs stand now? If I ordered a Class 8 vehicle today from an OEM, how long until I get it?
There is a great question right now. So just backing up, if we go back to last October, we saw the Class 8 backlog peak at just over 300,000 units, and the backlog to build ratio was about 10.5 months. So truly, you were really looking into the end of 2019 to get a truck in late 2018. In May, the backlog was about 215,000 units, and the backlog to build ratio was down to just over 7 months.
Is there a norm in these backlogs and the backlog to build ratio where you just consider, okay, this is sort of supply and demand are stable? Do those numbers exist?
Yeah, so yeah, historically we like to look at a backlog of 5 to 5.5 months as a normalized relative backlog, and on a volume basis somewhere in the kind of 125 to 150,000 unit range. So still a very good backlog. We did see we have heard anecdotes that at the beginning of the year the OEMs were saying you can't get a truck delivered in 2019. So, or if you want a truck in 2019, it's not going to come until the fourth quarter. And by the end of the first quarter, we heard reports that some of the manufacturers were saying, we can probably get you a truck, late third quarter, and we've been hearing more recently, if you really want a truck, we can probably get one to you in a reasonably quick amount of time. And one of the things we did see, we not only collect the aggregate backlog number, on a monthly basis. We asked the OEMs, when is your backlog going to be built? And one of the things that we saw in May was we saw, let's say about 15,000 units leave 2019 and get pushed into 2020. So we saw of the backlog that's available, the 2019 backlog dropped by about 15K, and the 2020 backlog rose by about 22,000 units. So the truckers and the dealers are out there. They say, we still want these trucks, but we really don't need them right now. That's so that we're just getting to that inflection point note. That's kind of the genesis of that comment.
We're talking with Kenny Vieth of ACT Research, and you're listening to FreightWaves Radio on SiriusXM. You've had a very big collapse in Class 8 orders. The numbers are kind of staggering. We don't want to do too many numbers because they don't do well on the radio. But let me ask you, when everybody was in the middle of this incredible bull run last year, did you expect the collapse to be as severe as it's been? Did you expect this kind of return to the norm?
So certainly that was our expectation, and things, out of rare occurrence, things are actually kind of going according to plan right now. And even today, with a 215,000 unit backlog and a 7+ month backlog to build ratio, there's the front end of the backlog is still very full, and there's not a lot of need, especially with the giant inventory. So dealers aren't having to order a lot of trucks right now. So there's just not a lot of need to place orders in the near term. And just as an aside here, if I look historically, May through September is typically the weakest period of the year for Class 8 orders. So, the collapse that we've seen into May does fit with seasonality.
Right, but these orders, if I'm hearing you right, these orders that were placed last year or in the second half of 2018, they're holding up. The cancellation rate is not very high, which is one of the reasons why the backlog continues to be at a fairly healthy level. Is that a correct assumption?
Yeah, that's certainly correct, and I do think my comment earlier about some of the backlog being moved from 2019 to 2020 is kind of the precursor to cancellations. It's like we still want those trucks, we just don't want them right now, but we don't want to cancel them. So that's certainly a correct comment. The last several months we have seen very low cancellation levels, and as you mentioned in reading the press release earlier, we're getting good follow through on the guys that ordered the trucks, and seeing the trucks get built and seeing those get turned into retail sales. So we haven't really seen any slowdown at all in truck acquisition. So that's still holding up.
Okay, great conversation here with Kenny Vieth of ACT Research, but we have to take a quick break. We'll be back in just a few minutes. You are listening to FreightWaves Radio.
Welcome back to FreightWaves Radio with Chad Prevost and John Kingston on Road Dogg Trucking, Channel 146.
This is John Kingston. I'm here with Kenny Vieth of ACT Research. ACT Research does a for hire trucking index like a lot of entities do out there, and it came out this week, and not surprisingly, it was negative. But Kenny, you've had an interesting observation about the drop in that index, in that it's kind of masking the fact that the private fleets, in your view, in the last year have risen considerably, and that's not going to really show up in an index like that. It'll actually kind of maybe show up as a decline. Why? What spurred that growth in private fleets? And once a company goes that route, do they ever go back?
So yeah, I think as we were talking offline, I think this is one of the the unsung stories of the current weakness in especially the rate environment, and based on sources, I think Ryder, when they reported their first quarter numbers, they indicated they saw a 10% increase in leasing. The National Private Truck Council does a benchmarking survey every year, and their preliminary was the guys that participated in the benchmarking were up about 12% on a year-over-year basis. One of the problems, of course, with the private fleets is being private is they don't show up in the BLS employment data, and there's none of them reporting their financials, like you get with the publicly traded for hire and LTL guys. But our sense is roughly speaking, private fleets and the for hire market have roughly been had equal shares of the market, with the private fleets focused more on distribution as opposed to long haul segments or plant DC types of segments. They've traditionally been more involved with the customer facing stuff, and I think that what drove it is the capacity shortage that started in late 2017. You only have to go look at the DAT spot rate data, and followed 5 or 6 months later by the rapid rise in contract data is a lot of consumer products companies CEOs got blindsided in the first quarter of 2018, where they were having to explain to investors why they missed their numbers, and company after company in the first quarter of 2018 was explaining that the reason they missed their Trump numbers was because they got crushed on transportation. So I think a lot of CEOs green-lighted their private fleets to add capacity, and basically what drove it was that kind of 25% year-over-year growth in spot freight rates through the first half of 2018. Whether it goes back, I think the private fleets broadly have kept the what they perceived as the most valuable, that customer facing freight, and they parted with the kind of non-critical freight, if you will, and you've seen a lot of it go to dedicated over the years with some of the big for hire fleets, for example. So yeah, how sticky is it? I suppose it depends on how far rates fall. So that's given the demographic outlook, as we look over the next 5 to 10 years, and looking at workforce growth rates of 0.4, 0.5%. This is we might see a temporary abeyance in the supply demand imbalance tilting back towards shippers, but ultimately this is temporary, and the lack of employees is going to drive this back in a few years. But anyway, that was a long-winded explanation.
All I can think of is, not all I can think of, but one of the things I think of when I'm listening to you, and obviously I'm going to show my bias here as a employee of FreightWaves, but that freight futures could have probably been a lot easier than going out and hiring a whole bunch of people. But anyway, that's a subject for another day. Let's talk about that Class 8 surge from last year and what was the impact on the used truck market. When you saw these incredible order books from July through October, November of last year. One of the thoughts was, well, this is going to put a lot of trucks back on the used market when these new vehicles come in. Those trucks would be hitting the market in the last few months, as we talked about. What's been the impact on the used truck prices?
So used truck prices have so they're plateauing. They've been on a plateau for about 4 or 5 months now. So the good news is used truck prices aren't falling yet. So there's that to look forward to. But as we look and as we see the supply demand imbalance with retail sales continuing at a very strong rate for the next at least next 4 to 6 months in this slow freight environment or this freight environment where the private fleets have grabbed a chunk of freight back. We think that ultimately, the things that supported high prices that were driving small truckers to jump back into the market, those situations have gone away, and we do expect to see used truck prices from here, start to deteriorate.
How bad? Do you have a forecast of how much they're going to deteriorate?
So I should have asked our used truck expert before I left work on Friday, but I would think that on average, average used retail prices are in the low 50s right now. I would think, given the economy is still growing, that something, a 10% decrement would be a reasonable expectation. If we do tip into recession, and I think that's probably a conversation for another show. But if we do tip into recession, then I think that decrement could be a lot worse.
So, is the price of a used truck, or the price of used trucks, a lagging indicator or a leading indicator?
If you split the difference, it is a coincident indicator. So
okay. I could see where it could be both.
Yeah. So yeah. Unfortunately, it just doesn't provide any lead whatsoever. But as soon as things start going bad, you see the used truck prices roll off.
Okay, you talked about one of the reasons. Let's go back to the big Class 8 order books from last year, and one of the reasons for it is that trucking companies had a lot of free cash flow. And, of course, free cash flow is not the same as profits, but given that trucking companies tend not to carry a lot of debt, their profits are going to really turn into free cash flow, unlike, let's say, a tech company or a shale oil and gas driller. Is this the best way for companies to spend their money? Hey, we've got a lot of cash, let's buy some trucks. Does this ultimately pay itself back?
So this is, I would argue that this is ultimately the end of every cycle is because you do spend a lot of free cash at the peaks of the market, because almost all rate above operating costs goes to cash, and the alternative to buying assets is paying taxes. And there's a lot of small trucking companies out there, and you don't like big corporations, you don't have underperforming assets to park your money in, and savvy financial instruments to keep cash from the government, and one way truckers have is to buy assets, and quite frankly, I don't see it. I just don't see it changing, and ultimately, in this regard, truckers are their own worst enemies. Though, the flip side of that is, you look at the trucks that are available today, compared to trucks that were available even 5 or 6 years ago. You're looking at more than 10% better fuel economy. Automated manual transmissions have really come of age. ADAS systems, so lane keeping and automatic braking and adaptive cruise. The technologies like that have become very desirable as they have come to market.
Yes.
So there's a lot of reasons for guys to buy trucks besides just to avoid the tax man, but ultimately that's one of the, however it works, that's the end of every cycle where that supply demand balance tilts. And if I can add one more comment, is the problem with profitability lags the freight cycle. So you get the freight rates in the peak of the cycle, and your contracts extend. So the freight cycle started getting soft, kind of mid third quarter last year, and we had record profits in the fourth quarter, and the first quarter of 2019 was, kind of a top 5 quarter, even though it was down substantively. So these guys are spending a lot of free cash after the freight cycle.
Right, and then of course, Werner earlier this year did a special dividend. They were really the only one of the big publicly traded companies. That's a way of dealing with your free cash flow as well. So only have time really for one more question. So let's just ask about the general overall freight market. You do the for hire trucking index, and you're out there all the time. Are we near any kind of a bottom, or does this still have some deterioration to go?
We have a tractor dashboard along with our for hire index. So for the for hire index, it's a diffusion index. So kind of like the purchasing managers, where above 50 is growth and below 50 is contraction. The volume, rate, and supply demand balance indices in our for hire survey, which is about 50 to 60 truckers a month, have all been below 50 for the vast majority of the past 6 or 7 months, and remained negative territory in the May reading. Our tractor dashboard is a collection of 15 variables, 5 macro or 5 economic, 5 freight-related variables, and then 5 industry-related variables. If I go back a year ago, April, May, we were, the readings, the top line readings were +8, +9. And, April a year ago, we didn't have a single negative indicator. So, we had 9 positive and 6 neutral indicators. You flash forward to the May reading that we just came out with all those press releases that came out this week. We had an all-time record low, -13 reading. Wow. So if we go back a year ago, May, it was +8. The current May reading is -13. And again, there's only 15 variables in this collection. So the economic variables that we track, again, I talked about, manufacturing, machinery, auto, and housing, being, flat to down. The freight-related metrics, and it's ATA load, the DAT data, CAS, those guys that everybody that pays attention to this space knows and loves. And then, the industry related, or what I would call ACT data. So, backlogs and orders and production and cancellations and inventory. And those are all negative. Yeah.
I got to cut you off because it's time to go, unfortunately, but we're gonna have you back, and we'll see if things have gotten any stronger before then. So that's Kenny Vieth, the president of ACT Research. Thanks for being our guest today on FreightWaves Radio.